Hi friends, this is Ravi Kanth Miriyala. Right, my classes on CA final paper number 1 financial reporting are available on an academy platform. Yeah, these are recorded as well as live, and it is 100% comprehensive and 100% English batch, wherein we discussed each and every concept of Ind AS, which will be useful to the students even after qualification for practice purpose. Also, this will be useful. Yeah, please, inform your friends about this information. And on an academy platform, comprehensive batch on GFRS also is done. 23 classes, 69 hours, entire ICA material with PY examination questions and mock test papers also are covered in this discussion. It will be very much useful for CA final GFR, that is paper number 6E. Next, for my books, that is on Ind AS made easy, our financial reporting made easy, and fast track summary book. Yes, you can order in ravikantmiriyala.com, or you can contact the given number for the books. Right, for your doubts, clarification, please join the Telegram group Ind AS discussion group RKM. Let's have a look at Ind AS 8 accounting policies, change in accounting estimates, and errors. These charts are from my textbook Fast Track Quick Revision of Financial Reporting. This will be having all entire financial reporting 100% syllabus in the chart format. Yeah, this you can order it in the Amazon, Flipkart, and in the market, or you can order it from my website, that is ravikantmiriyala.com. Right, let us look at the subject. What are accounting policies? Accounting policies are the principles, or bases, conventions, or practices, or rules. You can say many things which are adopted by the entity for preparation, presentation of financial statements. Who will select this? Obviously, management. What kind of policy should select? Which will make the financial statements more reliable and relevant. It should be relevant to the decision making of the users of financial statements. Yep. So let's look at these accounting policies. Can be there for the purpose of valuation, that is measurement, I can say. Correct, no? Right. At the same time, even for the timing, yeah, timing of accounting recognition, at the time which time I should account for. If you remember accounting Ind AS 109, yeah, there is regular way of accounting you must have studied, that is trade date accounting or settlement date accounting. Yes, that is an accounting policy choice by the entity. It is applicable for the classification. Yes, sometimes you may choose it as FET OCI or FET PL. That is also as a part of choice. That is, choice is where accounting policy lies. Right. Next, what is the priority? How to select it? See, they have given the first and foremost priority. If the Ind AS is directly telling you follow this policy, or if they have given any one or two policies, you can pick out of those which is relevant to you. So as per the Ind AS requirement, you should follow. Or if there is no straight away information, Ind AS not it is given, but IASB or ASB has given guidance on related issues, then you can follow your accounting policy as per that IASB or ASB notification. Right. Sir, I don't have a clarity, I don't have direct standard for such kind of thing. Fine, then you can create a policy, or you can create a policy based on the definitions and recognition measurements of asset, liability, income, expenditure, equity. The basic definitions you can follow. That is the hierarchy number 2. Sir, here also I am getting confused. I am not very clear whether to recognize the asset or whether to charge it to P&L or what. I don't know exactly. Then you look at the recent pronouncements of IASB or ASB. Yeah, if they had given any guidance, then please follow as per that. No, I don't. They also have not. They are also silent on that. Okay, then you are supposed to look at other similar gaps like IFRS. In few places you can refer US GAAP as well. This is about accounting policies. Now, when there is a change in accounting policy, what are we supposed to do? Right? When there is a change in accounting policy, why the change first? You need to look at. And what is, if it is changed, what is the accounting treatment? That is second point. Why the change? Right? Change may be because it is required by the Ind AS. There may be an amendment to Ind AS. That's why there is a requirement. Change in the policy is required. Or maybe for better presentation, you can say. Better presentation means your financial statement should become more relevant and more reliable. Financial statement should become more relevant and more reliable. Under these two circumstances, you can say, yeah, we are changing the accounting policy. Right? But listen, adoption of a new policy, a fresh policy you are following, no, that does not amount to change. Change means what? Something is there, you're removing and you're bringing something. That is change. Nothing is there, now fresh I am bringing. No, that's not called change. This is adoption of a new policy. Second point, adoption of a new policy for substantially new transaction. A new transaction is taking place. For the new transaction, you are following a new policy. It is substantially new compared to previous year transactions or previous year circumstances or events. Done. And accounting treatment. Sir, what should I follow? First, it is linked to the change. If you are changing the policy because of the change in the Ind AS, 99.99% Ind AS only will give you guidance. Ind AS only will give you guidance saying, yeah, I mean, they will say you follow prospectively or retrospectively, something like that. They will be giving some guidance on that. Then those guidance you can follow directly. And if the change is like self, because you wanted to ensure more reliable and more relevant, that is for the better presentation, then you don't have any choice. That is only retrospective application. Retrospective application, as if the new policy is being followed from the day one. From the day one. Okay. That when you are changing this accounting, right, obviously what happens in case of retrospective application, in case of retrospective restatement, or in case of reclassification, you are supposed to prepare the third balance sheet. You are supposed to prepare the third balance sheet. Third balance sheet is nothing but previous year opening balance sheet. Third balance sheet is nothing but previous year opening balance sheet. Done. Right? So, and when you are accounting like this, you have to consider the effect on the reserves, effect on the taxes, everything you are supposed to follow as if you are following the new policy from the beginning. Okay, right. Sometimes it may be that retrospective effect may become impracticable. When do you say impracticable? After putting all the efforts, after putting all the efforts, right? Maybe because of the lack of information or because of some other reason, if you prove that it is impracticable for me to do it, then they have given some small exceptions. Yeah, they will ask you first, is it, what is impracticable? Is it to give periodic specific effect is impracticable, or cumulative effect is impracticable? Periodic effect means, sir, because of this change, how much is effect is happening in the PY, how much is effect is happening in the CY? I don't know exactly. Okay. Then under that circumstance, what I can say simply to remember in the quick revision, assume that is this new policy is followed in the beginning of the current year. That is 1/4/2021, I will say for financially 31st March 2022. Then 1/4/2021 only you followed it. That's the best thing. Okay, right. So far effect, I mean current year effect I know very clearly. Previous year effect I don't know. Just give the adjustment. So far effect will be given to the opening reserves. Current year effect will be given only to the current year. And we will be giving disclosure in this regard. Next. Sir, I don't know cumulative effect. Cumulative effect means I followed old policy from 2012. But my financial year is 2021-23. I don't know the cumulative effect from 2012 to 21. Oh, you don't know. Fine. Then from which year onwards you know it? Sir, I know from 2018 onwards data is available. No problem. From 2018 onwards only you follow it. I mean, from the earliest possible year, it is possible to follow retrospective. From that day, you please follow it. That is about change in accounting policies. Right. Let's go to the second topic. Change in accounting estimation. Estimation is approximation. Where there is no precise mean, then you will go with approximation, right? Estimation is there means revision is mandatory, correct? So then what are we supposed to do? What are we supposed to do? You will be following prospective accounting. Yeah. So estimation may change because of the more information, correct? More experience, because of the events occurring after the balance sheet date, right? You may need to change it. That change you should be accounting it prospectively. Prospectively means from now onwards, without considering the past. What have you accounted in the past? Forget about it. We don't go back, we don't restate anything, we don't prepare third balance sheet also in this case. Nothing. Forget about the past. Start following from today onwards as if we got the information today. That's it. Okay, right. The next topic, that is a small topic, I mean errors. What is error? This error includes omission. First of all, errors includes omission, which is like prior period error in accounting standard 5. Yeah, this error can be a mathematical error, it can be a fraud, it can be wrong interpretation of policy, a wrong interpretation of facts, right? So now what are we supposed to do, right? Even in, right, before going to that, first omission, let us spend some time. What do you mean by omission? Omission means we had the information, but we forgot to consider. Maybe that is a human error, that is oversight issue, I can say, right? Or, right, there is this point they have asked in the, I mean, examination, information that could have been obtained with reasonable efforts. Yeah, that point you need to remember these wordings. Information could have been obtained with reasonable efforts, but you did not obtain. And I mean to say, if the accountant has spent a good amount of time, he would have got it, but he did not try it. That's why he didn't get. That is also error, right? Under all these circumstances, what is my accounting? Retrospective restatement. What do you mean by retrospective restatement? You should go back to the last year or that previous year and account it, okay, as if error never took place. Go back to the respective year of error and account it as if never this error took place. That means you will be passing the journal entry in the last year or last before year. And if you suppose because of this there may be some expenditure, if there is an expenditure, then automatically tax impact will change, automatically reserves, correct, retained earnings numbers will change. All these things you are supposed to keep it in mind. And as I already told you, in the case of retrospective restatement, third balance sheet is mandatory. Okay, right. So if you can't follow this retrospective restatement, yeah, I mean whatever I explained just now, is it because of periodic effect you can't do it, cumulative effect, same rules and regulations are applicable even in this case. Okay, my dear, some other important points. Yeah, what are the important points? Restatement of financial statements does not amount to reopening of financial statement, a revision of financial statements under section 131 of the Companies Act. No, it is not. Suppose, right, change in accounting policy, right? When I say change in accounting policy, suppose sometime what happens, whether it is a change in accounting policy or change in accounting estimation, if you are confused, it is in a dilemma position, then treat it as change in accounting estimation and follow prospective accounting, not retrospective. Prospective you follow. Yeah, there are some few information. Change in NRV, correct? Now yes, you are measuring it at NRV, a NRV value is changing, that is estimation change, it is not a policy change. Last year theft happened, current year you identified, that is an error, correct? Now you would have done good job last year, audit you would have done correctly, or accounting people would have done correctly, you didn't do it. You should have paid good attention to it, didn't happen, it is an error. Yeah, you paid less insurance to the company because of they have given the wrong information, that is not my error. Insurance company should cry for that, not me, right? Next, change in useful life, change in the residual value, change in the method of depreciation, all these are method of depreciation also, all these are change in estimation. So prospective accounting only will be followed. Okay, interest earlier added to the inventory. Now it is not allowed, assume as per our standard. Then it is change in policy. Change in policy. Change in policy includes change in the basis of measurement, how you are measuring the valuation of inventory. Now a measurement basis change also amounts to change in policy. It is not just only LIFO to FIFO, FIFO to LIFO, not like that. Okay, right. So earlier you followed cost model, now you're going to revaluation model. Change in policy, right? Adoption of a new policy, a pension policy, no, adoption of a new policy is not a change in policy. This is the information. If you like this video, please share it with your friends, and along with that, comment, right? Is it useful, not useful? And do not forget to like the video and subscribe, right? For further videos, subscribe to my channel, Ravi Kanth Miriyala, that is YouTube channel. Thank you very much and wish you all the very best.